Assalamualaikum. My name is Muhammad Hidayatullah bin Rozaimi. My metric number is 06D8024F1177 and I will present about definition. Current liabilities are obligations that are expected to be settled during the normal operating cycle or within 12 months after the reporting date. The two current liabilities selected as example are creditors and bank overdraft. Now, I will present about creditor definition. A creditor is an individual or business that is owed money by another party. Creditor provide goods, services, or loans with the expectation of future payment. Creditor objective to ensure they receive payment on time, to assess the debtor's ability to repay outstanding debts, to minimize the risk of bad debts or defaults, to maintain a stable and profitable business relationship.
Assalamualaikum. My name is Amira Safia binti Padili and my matrix number is 06D8024F1008. I will be presenting about the audit approach for creditors. Auditors achieve their primary goal by looking at specific audit objectives, performing tests of control, and conducting substantive tests. There are 8 objectives. The first one is completeness. Completeness is ensuring no liabilities were missed. Auditors check that every invoice is matched with a purchase order and goods received notes before recording. Auditors also search for unrecorded liabilities by reviewing post-year-end payments. The second one is existence. Existence proves that creditor actually exists and the liability is not fake. Auditors ensure no invoices are processed without the necessary supporting documents and also management approval. Auditors confirm this by sending supplier confirmations and checking loan details. The third one is accuracy. It confirms that the price, quantities, and totals on invoices are calculated correctly. Auditors ensure invoices are checked independently for prices and quantities. Auditors then recalculate selected balance and reconcile them with supply statements to ensure everything matched the account payable ledger. Thank you. Next, we have valuation. By doing valuation, it ensures that liabilities are recorded at the right amount that is actually expected to be paid. Our test control involves checking if credit notes and returns are approved before updating balance. For substantive testing, we verify that liabilities are recorded at the expected payment amount. Our audit procedure here is to review these notes to ensure the creditor balance is correct. Next is cut-off. It checks that purchases received before the year end are recorded in the specific year. Regardless of when the invoice arrives, we must ensure purchases received before year end are recorded correctly. We test this by examining purchases immediately before and after the year end and by comparing dates on goods received notes against the account payable ledger. Then we have right and obligations. Right and obligations confirm the company is legally responsible for the liability and that it belongs to them. We verify that recorded purchases are supported by approved contracts. We perform substantive tests by inspecting these contracts and reviewing invoices to confirm the company truly owns the liability. Finally, we consider classification and presentation and disclosure. For classification ensures that money owed to suppliers is correctly labeled as trade creditors in the financial statements. We review controls to ensure all liabilities to suppliers are correctly recorded under trade creditors. We confirm this through a substantive test review of the general ledger and financial statements. Lastly, we have presentation and disclosure. Auditor review management's financial reporting checklist to ensure compliance with accounting standards. Presentation and disclosure ensures that all necessary details about the debts are written in the notes to the financial statements. following accounting standards. Auditors inspect the notes to the financial statements to verify that all significant creditor balance and related party payable are properly disclosed. Thank you.
Assalamualaikum. My name is Nur Adla bin Kamarudin. My metric number is 0688024F1024. Today, I will continue this presentation with my part. I will present about chronology of creditor. First step is purchase requisition. The auditor verifies that the PR was prepared by the requesting department and approved by an authorized officer to prevent unauthorized purchase. Step 2. Purchase order. The auditor checked that the PO was issued only after the PR was approved and that details such as item, quantities, price and payment terms are complete to ensure that the order placed with the supplier is valid. Step 3. Good delivery. The auditor examines that delivery order as evident that the goods were delivered by the supplier to confirm the occurrence of the purchase transaction. Step 4. Goods received and inspection. The auditor review the goods received note and inspection record to confirm that the goods received match the order in terms of quantity and quality, to ensure that only properly received goods are recorded. Step 5. Supplier invoice. The auditor check the supplier invoice for accuracy of supplier name, amount, tax and invoice date to ensure that the amount payable is correct. Step 6. Three-way matching. The auditor verifies that the PO, CRN and invoice has been matched before the liability is recorded to avoid payment for goods that were not recorded and not received. Step 7. Recognition of creditor. The auditor examines the journal entry. Debit will record inventory of purchase and credit will record account payable to ensure that the liability is recognized completely and accurately. And step 8. Record keeping. The auditor review the unpaid invoice file to ensure that all outstanding invoices are properly recorded and maintained to detect any unrecorded liabilities. Step 9. Payment to supplier. The auditor check payment voucher, check and bank transfer record together with the approval or authorized personnel to ensure that payments are made only to legitimate supplier and are properly authorized. And last step is settlement of liability. The auditor verifies the payment entry. Debit will record as account payable and credit will record cash and bank to confirm that the liability has been settled and the creditor's balance has been recorded correctly. Next, I will present about creditor's process. First step is purchase requisition and approval. Document involved is purchase requisition. The warehouse or operation department that requires inventory will issue a purchase requisition, known as PR. Authorized person, the department or warehouse manager, review the request and approve it by signing the PR. Account involved are known at this stage because no accounting entry is recorded yet. Next, step 2, official purchase order. Document involved is purchase order. The purchasing department issued an official purchase order, known as PO, to the selected supplier. Authorized person, the purchasing manager signed the PO as authorization to make the purchase. Account involved is none. This is only a purchase commitment. No journal entry is made. This is a supporting document of purchase order, evidence of the company's agreement to purchase goods according to specified price and terms. Step 3. Receipt of goods in the warehouse. Document involved is good receipt note, GRN and delivery order, TO. The goods are delivered by the supplier together with the delivery order. The receiving department counts the goods, inspect their quality and prepare a good receipt note. authorized person, the warehouse officer, sign the GRN after confirming that the physically quantity received is correct. Account involved, a liability begins to exist physically, accrued purchase. Next, supporting document, good received note GRN show the actual date the ownership of the goods transferred to the company. Step 4, receipt of supplier invoice. Document involved, supplier invoice. The account department received that the invoice from the supplier. Authorized person, the account manager approve the invoice after the matching process is complete. Account involved, the purchase and account payable are officially recorded. Journal entry, debit, we record inventory of purchase, and credit, we record account payable, known as trade creditor. Next, supporting document, supplier invoice, the official claim document from the supplier stating the exact amount of liability that the company is obligated to pay. Step 5, recording into the journal system. Document involved is journal voucher and account payable ledger. After approval, the transaction is recorded by debiting the inventory or purchase account and crediting the trade payable account payable account. If account involved, debit, we record inventory of purchase in Sochi or Sofi depending on the accounting treatment, and credit, trade payable current liability in Sofi. That's all from me. Thank you.
Now, I will present about bank overdraft definition. A bank overdraft is a short-term credit facility that allows an account to holder to withdraw more money than is available in their bank account, up to an approved limit. Bank overdraft objective is to provide short-term financing for cash flow shortage, to help businesses or individuals meet urgent payment obligations, to ensure smooth day-to-day operation when funds are temporarily insufficient, and lastly, to offer flexible access to additional funds when needed.
My name is Hazira binti Hamzah and my matrix number is 06D8024F1079. I will present about assertion for bank overdraft. First and foremost, the primary objective of completeness is to ensure that all bank overdraft transactions that should be recorded have been entered into the account books without omission. In order to evaluate this, we verify the preparation and independent review of monthly bank reconciliation, while simultaneously conducting substantive testing by comparing the general ledger overdraft balance against the year-end bank statement and independent bank confirmation. Consequently, our audit procedure requires us to trace transaction from the bank statement directly to the accounting record and inspect the year-end bank confirmation. For instance, if the bank statement reflects an overbalance of Rm 35,000 but the general ledger only records Rm 30,000, the auditor will investigate the unrecorded Rm 5,000 difference. Moving forward, existing established that the bank overdraft liability actually exists at the reporting date and is not a fabricated balance. With regards to internal control, we examine management and bank authorization procedure for acquiring and utilizing the overdraft facility, whereas our substantive tests focus on obtaining an independent bank confirmation directly from the financial institution. To substantiate this claim, our audit procedure involves inspecting the official bank confirmation, bank statement, and the underlying overdraft agreement. As a case in point, when the bank provide writing confirmation of an overdraft balance of Rm 50,000 as of 31st December, this balance must reconcile exactly with the financial statement. In addition to that, accuracy verified that the mathematical calculation for interest charge and related bank fee are entirely correctly. To assess the control, we check the finance department's review and approval process for interest expenses prior to recording, and subsequently, we perform substantive testing by independently recalculating the interest expense using the specific interest rate stated in the agreement. Therefore, the audit procedure involves recomputing the interest charge and cross-referencing them with the bank statement and general ledger. By way of illustration, if the bank charged Rm 1,250 in the interest but the company only record Rm 1,000, the auditor identified a Rm 250 understatement in finance costs. Furthermore, valuation ensures that the overdraft balance, including accurate interest and bank charge, is reported at the correct amount at year end. From a control perspective, we review management periodic monitoring and updating of the overdraft account balance, while on the other hand, the substantive test verified that the year-end balance and accurate charge are measured presently in accordance with accounting standard. In practice, our audit procedure requires us to compare the recorded balance against the bank statement and recalculate any outstanding accurate interest. For example, if the company record an overdraft of Rm 80,000 but failed to recognize Rm 2,000 in accurate interest, the auditor will propose an adjustment to reflect the correct liability of Rm 82,000. Turning now to right and obligation, this assertion confirms that the overdraft is a legal liability of the entity and not the personal obligation of the director. To determine control effectiveness, we verified the overdraft agreement was properly executed and signed by authorized representative of the company, while for substantive testing, we reviewed the term of the agreement to confirm the company legal obligation to repay the debt. Accordingly, our audit procedure focused on examining the overdraft contract and corporate legal document to substantially liability ownership. For example, when the overdraft agreement is executed under the legal name of ABC Sdn Bhd, it confirms that the corporate entity holds the legal obligation to repay the balance. Next, cut-off ensures that overdraft transactions are recorded in the correct accounting period. To verify this control, we assess the timeliness of the company year-end bank reconciliation process. And as for the substantive test, we examine transactions occurring immediately before and after the financial year end. Hence, the audit procedure involves reviewing bank statements around the cut-off date and tracing those entries to the accounting journal. For example, if a check issued on 30 December creates an Rm 12,000 overdraft but is recorded on 2 January, the auditor will require an adjustment to record it in the current financial year. Meanwhile, classification ensures that the bank overdraft is presented in the correct liability category on the balance sheet. Regarding the control, we evaluate the finance department compliance with accounting presentation policy, before closing the book, whereas the substantive test confirms that the overdraft is appropriately classified as a current liability. To fulfill this, our audit procedure requires a physical inspection of the statement of financial position to verify compliance with financial reporting standard. As a clear example, if a bank overdraft of Rm 6,000 is correctly presented as a non-current liability, the auditor will instruct a reclassification to current liabilities. Finally, presentation and disclosure ensure that all material information regarding the overdraft is transparently disclosed in the notes to the financial statement. In terms of control testing, we reviewed the management control procedure for drafting and checking financial statement disclosure, and concurrently, our substantive testing verified that disclosure regarding interest rate, repayment term, and pledged securities strictly complying with accounting standard. Ultimately, our audit procedure require comparing the draft disclosure notes against the actual clauses in the bank overdraft agreement. For example, if the company disclosed a Rm 100,000 overdraft balance but fails to disclose that the facility is secured by inventory, the auditor will require the inclusion of these breach details in the disclosure note.
My name is Zulaika Fana binti Shahrum and my matrix number is 06JT24F1039. I will continue the presentation with the chronology of bank overdraft and bank overdraft auditing process. First, I will briefly explain the chronology of bank overdraft. The process begins when a company anticipates a cash flow deficit. The finance manager will then apply for an overdraft facility from the bank. The bank will evaluate the company's financial position, and upon approval, both parties will sign a facility agreement. Suppose the company's bank account balance is only 2,000 ringgit, but they need to pay a supplier 20,000 ringgit, the bank system will automatically cover the 18,000 shortage, causing the company's bank balance to drop to a negative 18,000 ringgit. The accounting department will then record this transaction by debiting expenses and crediting bank overdraft as a current liability in the statement of financial position. The bank will charge monthly interest on this negative 18,000 ringgit balance. Later, when the company receives payment from customers, for instance, 30,000 ringgit, and disposes it into the bank, the overdraft balance will decrease and the account balance will return to positive. Once the company fully repays the overdraft balance along with the interest, the account balance returns to normal. However, if there is still an outstanding overdraft balance as of the closing date, that negative balance must be reported as a bank overdraft under current liability. Next, I will explain the bank overdraft process. First is review of banking facilities and authorization. Supporting documents required are facility agreement and board minutes. At the planning or interim stage, the auditor reviews the company's borrowing capacity. Auditors cannot simply take the approval at face value. Therefore, they will request supporting documentation, specifically facility agreement. This agreement contains crucial details such as the approved overdraft limit, interest rates, and any pledge collateral. Their role is to verify whether these details are accurate. Additionally, they will review the board minutes to ensure that this loan is legitimate and has received formal approval from the company's top management. This is an example of a supporting document minute of meeting. It is the official written chronological record of everything that took place during a board of directors meeting or an annual general meeting (AGM). Second of the bank overdraft process is verification of the year-end overdraft balance. Supporting documents used are trial balance and general ledger. Once the financial year ends, the auditor extracts the client's closing figures. The auditor will examine the client's trial balance and general ledger. The purpose is to verify the overdraft credit balance and ensure that the accountants correctly classifies this negative bank balance as a current liability in the statement of financial position. They must make sure it is not hidden as a positive balance under current assets. This is to prevent offsetting, where a company combines a positive balance from one bank account with a negative balance from another just to make the net amount look positive under current assets. Authorized persons is company accounting. Third is the calculation of accrued interest and fees. Supporting documents required are interest statements and bank debit advice. Overdrafts incur daily interest charges, which must be fully accrued up to the final day of the financial year. To ensure that the company does not manipulate or understate the interest expenses, the auditor will request the interest statements. They will recalculate the interest expense based on the daily balance and the interest rate agreed upon on the contract. This procedure is crucial to ensure that all accrued interest has been completely and accurately recorded. The authorized persons are company accountant and finance manager. Next is the external confirmation direct verification. Supporting documents used is bank confirmation letter. During the post-year-end fieldwork, the auditor sends a standardized bank confirmation letter directly to all banks the client did business with during the year. To obtain the most reliable evidence, the auditor will directly send a bank confirmation letter to the bank, and through the bank's official response, they can independently verify the exact overdraft balance, accrued interest, and secured assets without any potential management manipulation. They will then compare the balance stated by the bank with the balance recorded by the company's accountant to check for any discrepancies. Relying solely on internal company records carries a risk of falsification, which is why information directly from the bank is far more trustworthy. Authorized persons are the bank and the financial manager. Fifth is audit of the bank reconciliation. Supporting document used is Bank Reconciliation Statement BRS. Because the company's ledger balance rarely matches the bank statement balance exactly due to timing difference, the auditor evaluates the client's year-end BRS. This happens when unpresented checks occur when the company has issued a check to pay a supplier, but the supplier has not yet cashed it at the bank. On the other hand, uncredited deposits occur when incoming checks have not yet been processed by the bank. The auditor will calculate the additions and subtractions in the bank reconciliation statement BRS. Then, they will cross-check the balance per bank statement in the BRS against the actual bank statement and the bank confirmation letter received from the bank earlier. Finally, they will match the balance per book in the BRS with the balance in the company's ledger. This is an example of supporting document bank reconciliation statement. It is prepared by a company to match its internal accounting record with the external records provided by the bank. Last but not least of the bank overdraft process is vouching of clearing items. Supporting document used is post-year-end bank statement. The auditor performs a cut-off check on the reconciling items inside the BRS. The auditor will request the bank statement for the month following the closing date, meaning if the books close in December, they will want to check the January statement. They want to ensure that the pending unpresented check and uncredited deposits have actually been cleared by the bank. If an issued check remains uncashed for too long, the auditor will instruct the company to reverse it, because this will impact the true value of the reported overdraft liability. If these transactions fail to clear by the bank by the end of the following month, it serves as a red flag that the company may have manufactured fake transactions simply to make their overdraft balance to look smaller. This is an example of supporting document bank statement. It provides a detailed chronological summary of all financial transactions that occurred within the account during that specific billing cycle.
Now I will present about creditor conclusion. Creditors are important current liabilities that must be recorded accurately. Proper auditing ensures all creditor balance are complete and reliable. Strong internal controls reduce errors and fraud. Last but not least, I will present about bank overdraft conclusion. Bank overdraft provides short-term financing for cash flow needs. Auditing ensures overdraft balance are accurate and properly disclosed. And the last one is proper verification improve the reliability of financial statement.